Ladies and gentlemen of the crypto space, we're live on a Tuesday at 11:32 a.m., April 20th. We have no idea what's going on in the markets. Do we ever? The market might look like it's extremely bullish at times, just going up, 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 up only, hashtag up only. We have no idea what the markets are going to do. People talk about technicals and how they give insight into potential price action, but the contrary is the case. The technicals are a manifestation of price action. Price action is everything. It either goes up or down, and it's really an aggregate or net result of broad human participants, the market participants. That's really what price action is. It's a heck of a piece of analytical data that expresses the sentiment of market participants, how they feel about a particular market. Anyway, so this is why, I like to shy away from just focusing on the appreciation of assets, because it's volatile. You're talking about humans and emotions, and that's the last thing I want to bank on. Humans are irrational beings. And I don't want to, and that's really why in the legacy finance they talk about fixed income instruments and bankability and predictability. You can only live your life based on predictable or at least moderately predictable income sources. And anything other than that is speculation. So the more you can minimize speculation and craft and construct strategically chosen investment choices to establish a degree of predictability, the more certainty that exists in your life and your financials. I argue that's for the better. Today's episode is sponsored by Change Angel, the non-custodial swap exchange for social goods. Stop depositing on exchanges, not your keys, not your crypto, non-custodial DeFi, or nothing at all. Bam! Let's pop it over to the main screen and see who's in the stream. We got Syrup in the house, the GOAT. I'm decent, thank you. I appreciate it. I appreciate the kind words and the sentiment. Igor's in the house. Barry, a pleasure. Carlos, 420. Yes, indeed. Crypto Yogi, thanks for the knowledge and insight. You're very welcome. I wish I could do more. I say that all the time. 2710, peace. Yeah. And Montana's in the house. Always a pleasure. Yes, sir. Wave mappers. All right. So, yield versus asymmetrically appreciating assets. It's all about risk versus reward. And what I have found my focus on is yield to establish a core portfolio structure that has increasing degrees of predictability. And you could compound, no, not the compound platform, but you could compound your yield into dollar denominated form using platforms, derivative assets such as Yarn. But I've opted for direct curve participation because the yield emissions are denominated in CRV, which are speculatively and asymmetrically appreciating asset. So you can mix and match all you want. There's endless options, and that's the whole point. There's no such thing as a perfect portfolio. All there is contemplation and consideration and respect for your capital that you've been so grateful to accumulate, and you attempt to deploy it as best as possible. It's a dynamic process, and there's no such thing as perfect. It's an ever iterating structure, ever a crafted structure, and then I argue it has overtones of an art or a sculpting of sorts. It's an expression, poetry in some regards. That's the way I talk about coding in many regards when I actually had a passion for it. So Curve is probably one of the strongest monetary policies in the entire crypto space. Interestingly, Pickle just kind of adopted somewhat of a curve strategy, which I find interesting. And I'm trying to get over my distaste for food memed projects, but Pickle's been around. There's only a couple of like serious remaining projects from 2020, and two that have lingered or retained some degree of relevance. I mean, Pickle's still relatively a cheap asset on the market cap side. Um, but Harvest and Pickle come to mind, and Badger as well. Badger has a huge amount of TVL because they deal with wrap Bitcoin type products. But what basically these protocols, I consider them second layer DeFi. First layer DeFi facilitates transactions, AMM, so on and so forth, that have the attached monetary policy, basically their version of digital fiat currency. That's a fun topic to discuss. But Badger, Harvest, and Pickle have these second layer uh, uh, market fit where they don't have the transaction capacity, but they have a monetary policy. They've created a fiat currency that has an inflationary component, predominantly decaying inflationary emission schedules, coupled with deflationary feedback loops. Now, Badger, for instance, has pools, and that's a deflationary pressure. And Pickle historically had pools, but Pickle now has pickle locking and 1, 2, 3, 4 year time horizons, just like Curve Finance, and that's a significantly greater deflationary pressure. Incentivize supply disruption. It'll significantly decrease circulating supply over time, which is exactly what happened with Curve. So Curve at the beginning, the incentivized emissions were being liquidated. Of course, it's inflationary. And that drove the price down to like 25, 30 cents. And then finally, people started to pick up on the long-term narrative for the protocol. And they're like, what happens in 5 years? What happens in 4 years? Maybe it's doing 10 billion, 20 billion, $100 billion in transaction volume a day. Even a moderate amount of curve is going to be extremely valuable. I have a small amount of curve, a 50,000 curve. Lock this VE curve, it's large in dollar denomination relative to zero, but relative to the big players that have a million curve, it's small. But the whole point is my yearly earnings on just having a VE curve position is right sitting at 14,000 a year at 9.9%. I've seen these numbers much higher. There's different times in the market, but if curve is all of a sudden doing 10 billion a day, 50 billion a day in transaction volume, what are we at? We're at average daily earnings. No, that's earnings. Average daily volume, weekly earnings, weekly volume. 3 billion. They don't have a daily volume? Daily volume, 226. So if this is doing 10 billion, let's say it's doing 2 billion, that's a 10x on daily volume. In theory, if that's maintained over the course of a week, this curve position is pulling in $141,000 a year. If it's doing 20 billion, this moderate curve position is pulling in $1.4 million a year. So that's and 20 bill might actually be on the short side, considering the potential for the platform over the course of years horizon. Speculatively, that actually empirically, Curve has proven itself as the forex of the crypto space, dealing predominantly with like value assets. Now, obviously, the narrative gets complicated with Uniswap v3 folding into the mix with their fixed a capacity for LP positions to target particular regions of the curve, and they could achieve similar effects to curve functionality. And we'll see how that unfolds. One thing I do know, aside from the technological overlap, is that Curve has momentum. It has integration. It has synthetics integration, and network effect is in play in full effect. It is near impossible to disrupt an ongoing disruption, and it is quite possible that Curve has an entrenched market fit for the functionality it has been offering, continues to offer, and likely, based on human predictability, will continue to offer. This is the market fit, and they will evolve. I'm sure they're doing a significant amount of work. This is usually why I stick to DeFi majors. You're talking about uh, teams and developers that have produced products that have defined, predictable functionality, and we have a year of experience, a year plus of experience with these protocols and platforms, and we kind of know who's building them, and we know that Hayden and his team are very smart, and they have access to a huge amount of resources, and they're basically basically a unicorn in stock market standards, with probably 6 billion or so last I potentially recall they have in treasury available for to capital deployment for innovation and marketing, so on and so forth. That's an immense amount of capital. And Curve is probably in a similar situation. They're dealing in billions. They're not dealing in millions. That's quite meaningful. All the boys on Curve are on LinkedIn, so this is a very public crew. And that's what you're getting when you're dealing with DeFi majors. When you're dealing with small projects, you're dealing with risk. You have no idea who you're dealing with, who's the developer, and of course, the intentions of the developer. So the more nascent the platform, the more nascent the protocol, the more risk involved. We're seeing much less, if any, rug pulls. So we're not seeing that kind of malicious activity nowadays, which is a massive shift compared to where we started in the 2020s. And to the point where I think most new entrants don't even think about it. On Ethereum, at least, Binance Smart Chain is an absolute shit show. That's another story. But for Ethereum, in a matter of a year, the platform has evolved into uh, a risk considerate place of operation. It's not full on degeneracy, or maybe it is. I have no idea what the hell goes on in Uniswap and some of those DEX tools protocols, and um, maybe it is still full on degeneracy from what a shit for what the heck do I know? But if you stick to the majors, you have that predictability. You have a greater degree of certainty, and I would say you have a relatively significant degree of certainty. Let's keep it going. Who am I missing in the stream? Rita's in the house. Always a pleasure. Gonzo, good morning. Cal, my man. uh, I hope you're enjoying your views. You got the best views in the room. I know it. Those gas fees, the past 24 hours, yeah, 366. Market's on fire. And this is exactly why when the market's hot, you really want it to be in position. And you don't want to really make too many adjustments. Clearly, there's reason to make adjustments. In fact, Sunday, when things were tanking, I did make adjustments. I liquidated a couple of positions that obviously were in a loss, and I ended up padding the dollar portion of the portfolio to achieve specifically my monthly yield interests. So I bumped it up a fair amount, and folks see this, and it gets into financial management territory and personal finances, and everyone's different. But this isn't a lot of money. I owe a massive tax bill, and it gets really complicated to manage personal finances. Um, They'll need to save for like 10 months at this salary to pay the tax bill at this point. But I have obviously other revenue streams, and you really want to protect your principal. So you don't want, if you use your principal to pay your tax bill, you're going to significantly disrupt your revenue stream. So that introduces a complexity, and also there's a variety of options to deal with that type of reality. Anyway, let's keep it going. I digress. I digress. 2710. Did you see X Token release their tokenomics plan yesterday for XTK? Yes, indeed. I've been speaking about four assets lately: X Token, um, Alchemist, Visor, and Method. Of the four, X Token has the most established and publicly visible social media interactivity, I would argue, and they've been around longer. So they've been dealing with the ERC20s and obviously the wrap DAO assets to facilitate APR to APY conversion, which is cool. And that's the way they started. And they all the reason for them to technologically jump on the UniV3 bandwagon. Alchemist also has a significantly muted risk profile because of who's been building it. The primary developer of Alchemist also built Token Geyser V2 for Ampleforth, and that's significant to say the least. The increasing risk profiles are with Visor and Method, whom we do not know who the developers are. There's little GitHub activity. They're forks off of Alchemist. Um, all three of them find themselves in an interesting state. Alchemist has no user interface whatsoever. Visor and Method cranked out a user interface in a relatively short period of time to facilitate staking, and which Alchemist obviously has as well, but you have to interact with it using a hard hat binary at the terminal level. There's no simple way to withdraw assets, so the vast majority of market participants that are allocating capital to all three of them, they're not in a position to interact with the smart contracts on Etherscan to do a capital withdrawal. And that introduces a bit of uncertainty to me, one with regard to pricing, because if incentivized emissions cannot be withdrawn easily by the vast majority of market participants, that's going to create a distortion in the pricing. That's basically an incentivized supply disruption, and that release valve, once the UI components easily facilitate the capital withdrawal, that's going to have a heck of a depreciative effect. It's going to be a large dump on the market as you know 1,000, 5,000 small players that have been accruing hundreds of percent yield, just dump $100, $100, $100. Small market actors, but cumulatively, that should trigger a significant amount of asset price depreciation. So there is a great deal of risk with all three of those assets to depreciate as the user interfaces evolve. I also share sentiment about just it's risky, visor and method. We have a reasonable amount of medium activity for both the platforms, um, which is a good sign. Um, and the reason I've taken position, and it's a much larger risk profile than I'm usually comfortable with. As I say, I stick relatively to mostly to DeFi majors. Um, but who knew about UniV3? Who knew about Alchemist? And who knows how to code Solidity and Viper type smart contracts? I myself am an Android developer, and I know a huge amount of persons in the industry. It's not a large industry. Um, so you get a sense of the size of the industry. And if Android is the size that I think it is, Android software engineering, the size of Solidity and Viper communities, and the amount of developers is significantly smaller. Um, so the speculation that I have, at least from the Hopium standpoint, is that all these developers know each other, or maybe it's even just pseudo anonymous, and they are the same developers, just spinning up a couple of different platforms. You could easily fork it and deploy it with modified tokenomics. That's relatively trivial, especially with public source code on these contracts. So there's a variety of positive ways to spin the speculation, and you don't have to head down the road of thinking they're in it for malicious intent. I mean, the Medium articles really diminish the malicious intent. Look at that effort put into the Visor documentation, as well as the method documentation. Obviously, Visor's a bit further ahead with the sophistication and details in their documentation. But technologically speaking, Method and Visor are identical. They're both forks of Alchemist. So, you know, risk adjusted returns, there's risk, but they could actually be both massively valuable projects. I know folks just ape into things and buy things and allocate a huge amount of capital, but that's exactly why I talk about the things on this stream the way I do. Understand the risk you're taking. At least understand that you're taking a huge amount of risk with a lot of these assets. So that was a long answer to your question, 2710. My man. Gonzo, this is why I was attracted to WGR. Wager because coins get burned after the bets. What are you talking about? Just the deflationary pressure. And that's old school. Wager's old. I remember Wager from like 2017. I haven't heard that name in a while. Um, and Masternode. So you're talking about an entire blockchain unto itself, which means it has centralized exchange liquidity, no DeFi interoperability. So food for thought. I really think the opportunities in the DeFi space, cross chain bridges. It's easy to get capital in and out of Matic. Neglecting the 7-day withdrawal period from Matic, but that's another story. But Cosmos and Polkadot are going to be absolute fire. Um, Flare is going to be fire. Plasm on Polkadot. They're already working on the cross-chain bridge to Cosmos, and the activity, the potential, and the seamless interoperability between Polkadot parachains and Cosmos hubs is going to be fluid. So you're going to have blockchains interacting with one another seamlessly within those ecosystems, and then the bridges between Polkadot, Cosmos, and Ethereum are just going to facilitate capital flow, just seamless liquidity. Everything is just coming together, and it's going to be so extraordinarily seamless in the coming months. I don't think it's going to be years out at this point. It's getting really close. Convex, Carlos. That's right. Convex is cool. So convex is Yearn, but it provides you the curve emissions and facilitates organized VE curve boost, which is cool. So I like convex. It's not. I'm looking forward to the convex airdrop. I'm not necessarily going to participate in it, depending on their monetary policy, particularly because I can interact with Curve directly because of my relatively meaningful VE curve position. But for persons that do not have a large VE curve position, convex is the way to go if you want the CRV emissions rather than APY compounding on dollars offered by Yearn. Matthew, Alchemix, does the fact that ALUSD doesn't appear to be very stablecoin, pose any problems for the protocol? No, that just has to do with the size and scale of the market, albeit there is always something to think about with regard to a stablecoin's peg to a dollar. I think Alchemix is a well thought out, crafty, intelligent derivative asset. Or even a derivative platform. And that's kind of what's needed for DeFi to be able to reach a larger user base. Most people aren't sophisticated enough to even interact with Alchemix. A lot of the general public is going to need to interact with these DeFi protocols over a telephone, asking someone to do things for them. So, a lot of what's being built is going to be wrapped around companies to offer support and interactivity with these protocols. Very early stages. This is early internet stages, and you can only imagine what it'll be like in 10 years out. So you guys are early, and it's very complicated topic because what we care about is price action today, and it's very hard to put yourselves in shoes of yourself in 10 years and envision what the price action is in 10 years because shit, we need to pay bills at the end of the week. Managing capital is very difficult. It requires potentially extremely long time horizons, a departure from the way we process information on a daily basis. You know, we're thinking out into the future and taking actions today. It's not something most folks do. But the better you do it and the better you train yourself to not think about today, but to prepare and plan and act according to what you hope to occur in the future, the better and more likely the future is going to play out in your favor. And that's the whole point of active financial management. Let's keep it going. John said, any advice on how to learn about crypto yields farming? DeFi Dad on Twitter and Bankless HQ. And you're welcome to ask me any questions. I don't do tutorials, but I'm happy to chat. And obviously, I have Noah's office hours. I'll post more links on Twitter. I usually post them at least daily. And I'm happy to answer any questions that you have and help you make better decisions, better risk adjusted decisions, risk considerate decisions in a space that's filled with infinite options, a fair amount of risk, especially if you're talking about Binance Smart Chain. Which are basically why they talk about Ethereum in terms of the dark forest. There's predators. And even if you're talking about purchasing an asset and looking for price appreciation, these people are wolves. They'll buy a large quantity of an asset to bump the price, and they manipulate markets. It's a free and open market. So price action notwithstanding, then you're talking about DeFi protocols and yield. You got someone that throws in $100 million and farms something extensively, like was it 0xB1, the very famous OG DeFi whale that's probably rolling around $750 million at this point. Was famous for bootstrapping a lot of the DeFi protocols in 2020. And he would farm, but he was very altruistic, or the team, or whomever they were, very anonymous. Because they wouldn't dump. Could you imagine someone with 750 mil bootstrapping a brand new baby project with like 50 mil, 20 mil, and getting millions of dollars in emissions, and they weren't dumping? Because if they dumped, they would have destroyed the protocol, would have literally just crashed it. The monetary policy wasn't strong enough to support that kind of liquidation process. It's outright fascinating. We've kind of gotten to the place we are in DeFi because the participants in DeFi wanted it to get to where it is. Because if they wanted to destroy it, the money could have. The people with 100 mil farming these things could have destroyed protocols, but they didn't. They weren't malicious. So it's interesting to see that in hindsight and to know that we got to where we are because even the wealthy wanted it to happen. Um, Killis, newest person in DeFi, where do you recommend I start for best yield? KuCoin Celsius. Yeah, so dollars. So take your dollars and you get it onto your hardware wallet. USDC, GUSD, and even USDT for nowadays. That's a topic unto itself, but they're just fine. Once you have dollars, your first experience is to put them on Aave. Aave is your bank account. It's not producing a huge amount of yield. You probably get about 8 to 10%, which is better than probably what you're getting on the centralized protocols. Like 6% on Celsius, I guess. But point being, at least it's DeFi, and that's the bank account. I don't have, well, actually, I did have on Aave, but that was on Matic. That's another story. But once you go there, and once you get risk off DeFi, risk off yield, that's a bank account, boys and girls. Aave is something special. Cresco Fin out in Switzerland, they're doing stuff with Aave. It's just liquidity. It's a money market. I'm just daydreaming real quick about a couple of years out, 3, 4, 5 years out, what this ecosystem is going to be like. But you get your capital into digital form, which is so easy to get capital out of DeFi. Literally, with a Gemini account, you convert anything to GUSD. You send your GUSD to Gemini, and they automatically convert it to dollars, and it's an ACH to your bank account in 2 days. And daydreaming again about a couple of years from now, you got Monolith, that wonderful DeFi credit card across the pond. What's the point of taking your money out if you could pay your credit card with in a DeFi manner with a simple Ethereum transaction or whatever smart contract transaction or whatever platform in the future? What's the point? If you could pay your credit card with digital dollars, I have literally little to no need to extract capital to a bank account. I've tailored the vast majority of my life to be around credit cards. I mean, I use American Express, but um, I don't carry balances. My whole point is that's a whole nother topic of debt. But if I could pay a credit card uh, with um, with digital dollars, that changes everything about the way I handle banking with regard to centralized institutions. Lucky Logan, greetings, Noah. Love the curve info. Would you have been able to give an assessment of Hex as an option for passive income? So Hex finds it is a very sophisticated monetary policy, but here's the complexity. It has a massive, massive supply disruption. Um, years, years. So what happens in? So let's say here's the high level with Hex. Let's say 50% of the platform are locked for 4 years, and they're making thousands and thousands of percent interest. What do you think happens in 4 years when a tremendous amount of assets are freed and the accounts come to maturity and people are sitting on tens of thousands and hundreds of thousands of dollars worth of profit? You're going to have a liquidity event. It's going to tank. But the problem is, and what's so frustrating about the time, is that you'll have to wait for all those years to see the protocol's monetary policy play out. So now every protocol gets credit for crafting a sophisticated monetary policy, but when you're talking about having to wait years to see if a monetary policy actually works, um, I would have no interest in doing that. You need liquidity. You can't disrupt supply that much. Um, so I have little to no interest in the Hex platform in that regard. Yeah, Aaron, Curve launched on Polygon. Pretty cool. I moved my Aave capital over to Curve. Let's see if we have it. So I I was a pretty high owner of the pool this morning. I think I own 26% of a Curve pool, That was crazy. So yeah, 119K worth of volume. I'm making some nice base APY, which hasn't updated yet. That's pretty cool. That's pretty cool. All right, so it's Curve. You guys know what Curve does, and it's basically free to do transactions on Polygon. And Binance is having some serious issues with BSC pretty much over the last couple of days, and I only think it's going to get worse. They're bottlenecked. They have a serious throttling problem, which is solved on Ethereum by high transaction fees. High transaction fees limits interactivity, but a person can pay a premium for a relatively quick transaction fee if they want. I could have a transaction fee on Ethereum go through at any time, even at 331 Gwei. I just have to pay for it. You can't do that on Binance Smart Chain, and that's the problem. That's a problem. That's a systemic infrastructure problem. They thought they were solving a problem by making the transaction fees smaller or whatever they did. I think they made the blocks larger to get the throughput. But as of right now, you're probably not going to be able to get a transaction through in a relatively short period of time because they're completely overloaded. Solved on Ethereum because of high transaction fees, where you could pay a premium to get to the front of the line if you want. And folks may not like that, but at least it works. At least you don't have to, you're not stuck. And if you can't do a transaction, you don't have a functional network. You got people right now on Binance Smart Chain probably sitting on hundreds of thousands of dollars of gains in that SafeMoon garbage. If you can't sell it, uh, that's really bad. One, it's not realized gains until it's sold. Two, if you can't sell it, someone else is selling it, which means you're losing your profits. And three, the odds are in a cascading depreciative cycle, when the vast majority of market participants have no capacity to experience a 10% drawdown, and that triggers, the fear of loss of value, and it just boom cascades, and it cascades quick. Couple that with a platform that can't execute transactions in a timely manner. Oh, that's a recipe for absolute destruction of capital. So people are going to see, I'm up 250 grand today. Yeah, at the end of the day, they made like 2 grand. That's going to be absolutely brutal. Um, I know you're getting into opportunities when they are less mainstream. Does that mean you'll sell? Yes, yes, it does. So I made a lot of capital with Rook, and I love the narrative, but price action and profit have little to do with I hold allegiance to my portfolio. I love the narrative for Rook, but I capitalized the crap on it between $65 and $800, and in fact, that was the second most successful position I've ever had. The first one was basically three assets: Kyber, Bancor, and Synthetics in March of 2020. Buying Bancor 20 something cents and Synthetics at 70 cents. So between those three assets, and then Rook, it changed my portfolio, and I'm hopeful that this will be the next critical trade. Yeah, you sell. If I could get a 10x on Visor Method and XTK, I'm gonna liquidate. Unless the XTK tokenomics are indicative of sustainability. I know Visor and Method don't have that kind of tokenomics yet. Alchemist will likely be more developed. Because they have the primary developer from the source, which is Token Forge V2. But 10x is massive, guys. 10x changes everything, and your allegiance isn't to an asset. You're not doing them any favors. So if you can if you capitalize like Doge, people buying Doge, hoping it pumps, and there's people buying Doge, they bought like 5 grand worth, and it's worth $250,000 or $500,000, and they're like, I'm not selling. I'm going to ride this thing to the moon. You made $500,000. Sell it and put it into Curve and make 30% of your money, and all of a sudden you're making $200,000 a year, and you don't have to work anymore. At least until the monetary policy evolves and you see what kind of yield is remaining. But the point is, don't miss opportunities. And you might love a platform and a protocol and think it means something significant to the world, and in many cases it does. Like Digibyte, but Are you really going to let something like that negatively affect your portfolio? Um, hold allegiance to your portfolio. Do what's right, and what's right is what's right for you. You're not doing the protocol any favors. So that's just honest opinion, and I think it's reasonable, and I also think it's rational. Um, and there will always be someone buying it. Because when Uniswap v3 comes out, that's when the vast majority of the market's going to find out about it. If you really think about it, right now it's completely off the radar. Nobody knows about any of this stuff. The vast majority of people providing liquidity on Uniswap have no idea what they're doing. They're throwing 1,000, throwing 2,000, pairing it with whatever because maybe someone told them it has high APY, and they exit 10% of their LP position to buy something else, 5% of their LP position to buy something else. And when they're on Uniswap v3 and they realize, oh, they can't sell 5% of their position. They can't sell 10% of their position because it's non-fungible tokens. They have to exit their entire position. Or when they have their LP position and they're getting no interest because there's no reinvestment automatically, they're going to realize, oh, maybe the platform's different. Then they're going to Google the word fungibility, and then they're going to find out about the exact same narrative that we've been discussing for the couple weeks at this point. And that's when the market realizes, oh, who's managing these NFT LP positions from Uniswap? And then they'll see the documentation for Uniswap v3 said third-party providers. Third-party developers will manage Uniswap v3 LP positions. My man Taiki. That's the deal. Carlos, what's a clear sign that shows you need to leave a position? I'm no longer married to my assets, but I still hold for a long time. Irrational exuberance, significant capital gains. If you make a 10x on an asset, take the profit, move it into dollars, make 30% of your money and change your life. Seriously. So Bitcoin and Ethereum are another story. Arguably, just deflationary assets in the long term. So Bitcoin's a decaying inflationary asset, but arguably Ethereum 2.0 is going to be a straight up deflationary asset. So there's a degree of macro narrative that really takes you over the threshold where it's like, yeah, I'm just going to hold this thing because it's beyond tokenomics at that point. I would argue it's monetary policy, just like you would talk about a currency. And that's really a line that I see extremely blurred nowadays. And nowadays I'm beyond tokenomics. We're talking about these assets as if they were currencies because we're talking about inflation, deflation, velocity, so on and so forth. Anyway, so you have to understand those properties, Carlos, um, to know if an asset has longevity. For instance, Curve, 4-year locks. And to top it all off, those 4-year locks provide you a recurring revenue stream. So you're actually incentivized to keep the assets after 4 years. If Curve is doing 10, 50, 100 billion a day in transaction volume, why the hell would I sell my Curve? That's a heck of a dividend. Legacy financial terms applied to new tech. And that's what's absent for Hex. There's no dividends, there's no transactions, there's no sustainable yield. All there is a monetary policy. It's a level 2 monetary policy. It's all it is a fiat that has inflation, deflationary pressures, so on and so forth. But there's no transaction fees. There's no sustainable revenue stream like the L1 DeFi protocols. I call Curve, Uniswap, Bancor, Balancer, Kyber, 1inch, L1 DeFi protocols because they facilitate returns to market participants from transaction fees, the only sustainable source of revenue, period. Kill us, exactly, Noah. Pay your bills, make some income. Folks are playing this game like they want to turn $1,000 into $1,000,000. What the fuck are you going to do with $1,000,000? Learn what you're going to do with the money. Learn what you're going to do with the big money. Now, when you don't have it, because when you have it, you're not going to know what to do with it. And the answer isn't to spend it. The wealthy don't spend their money. The wealthy use money to make money. And the money they make, they spend. That way, you're never spending your principal. Never spend your principal. Just saying. Dr. T in the house. Want to experience buying something on Matic today. Finally found some time. Yeah, Matic is pretty simple. I'm going to wrap up on this note. Matic web wallet. So you connect to it with Ethereum. And the Matic bridge, you could basically transfer stables. There's not much else you could really do at this point. But this with the 650 mil in liquidity from Aave and Curve porting over, you guys see what's going to happen. It's going to go straight up BSC. It's the chicken and the egg to get monetary velocity, but it it's kind of funny how monetary networks are born. You kind of need one or the other. You kind of either need the DeFi protocols or first or the liquidity. But you can't do it without either. You need the liquidity, and then you need the DeFi protocols to facilitate interactivity with the liquidity. And the DeFi protocols obviously have their own monetary policy. So basically, what the way it looks is we're seeing the starting of a brand new monetary network on Polygon. Metaphorically, what I see it as is like gas tank. What the the money market of Aave is like the gas tank, and then the DeFi protocols are the engine. So now that you have gas filled in the gas tank and the DeFi protocols start putting over their platforms, you have the engine, and then when the engine kicks over and you start to have the gas flow, that's your monetary velocity. So right now there's barely any monetary velocity, but you have the liquidity, you have the gas in the gas tank, and Curve heading over there is going to really light a fire. And there's so many protocols, butts, and it's permissionless as compared to BSC, which you have to use the Binance bridge. You need a VPN and all that other mumbo jumbo. Okay, let's get on Matic. I'll show you guys, and then we'll wrap it up. Okay, 1 second. I don't do tutorials, but when I do, sure as hell takes a lot of time. DeFi Dad's better at this than me. So the Matic web wallet's nice and simple. You connect to it using Ethereum. Anyway, so aside from the account selected, move funds to Matic. It's the bridge, and you can move whatever you want: Ethereum, USDC, USDT. As simple as that. So there's nothing really to do on Matic right now. Just food for thought. But you throw it into Aave, throw it into Curve, and you start building a Matic position without even having to buy Matic. And that's what I like about it. Barrick, thanks, Noah. Need some more office hours ASAP. I'll try my best to be on. I have some work I have to do for a company, and but I'm going to keep office hours open today. If anyone has any questions or wants to talk about choices and they're worried about the amount of risk they're taking, or they want to explore how to pursue risk adjusted returns and lock in some gains and use crypto dollars and generate revenue, and instead of working, you're putting your dollars to work, and that's a big departure from the way most people, especially new entrants, are looking at Doge. They're going to buy Doge and make $1 million. I have no idea what to do with $1 million. Someone gave that person $1 million, it'd be gone. It'd be gone, and once it's gone forever, and you miss the opportunity of a lifetime. Tuesday, 12:16 p.m., April 20th. 61 people in the stream, 22 likes. We can do better. As always, I thank everyone for joining, and I will see you tomorrow. Peace.